Hello everybody, welcome back to my channel where we talk all things finance and investing. In today's video, I'm going to tackle the subject of investing purely for dividends versus investing for growth or in growth companies across the stock market. I wanted to touch on this because a lot of new investors see dividend yields when they're doing their first bit of research, 4, 5, 6, 7%, and they want to rush in and buy that stock to collect the dividend. So we'll get into it today and break it down and see what you should go for. So on that note, let's go for it. All right, so first of all, what is a dividend? And a dividend is really just a payout to you as the owner of a company, shared ownership of a stock. That's what a stock actually is. And when the company has profits, well, then it tries to decide what to do with it, reinvest in new projects, or pay some out to the shareholders, the owners of the business, in the form of a dividend. Very common practice. And if they do, you will just get a certain amount, say a couple of pence or cents per share that you own in the business. And it's usually expressed in a percentage term known as the dividend yield. So a real simple example, if a stock is trading at $100 or £100 and it pays out $1 or £1 in dividend, then it would have a 1% dividend yield. And of course, when people are new to investing, the higher the dividend yield, the more excited they tend to get. But this is not the way to do it in my view. Now, the thing is about dividends, they're great when their companies are paying them. But what if the company has a really bad year, or they get hit, say something like COVID, for example, or they have some sort of crisis and they decide to cut the dividend or reduce the dividend? Well, this could have catastrophic effects on the company's share price itself. So one of the main things, if you are going to buy dividend paying stocks, you need to make sure that the company has got a plan to pay their dividends for the future, a lot of cash put away to pay it, whatever, because if they don't do it, then the company's stock price is going to absolutely crash. We've seen that many, many times over the years. Now, another thing to know about dividend yields, sometimes the highest dividend yield companies have actually just come through some sort of a crisis. So maybe their dividend yield was 4 or 5%, but they had some sort of maybe an accounting error or whatnot and had a crash in the share price. But when you factor in the most recent dividend paid, that yield there shot up because, well, in my example before, if the share price is $100 or £100 and one dividend was paid out at 1 unit, $1, one pound, well, that's 1%. But what if that stock price went down to 50? Then all of a sudden the dividend yield is going to double because there still will have paid out the $1 or pound as a dividend. And this is known as a dividend trap, and it's very common for companies like, say, tobacco stocks, for example. They're notorious for paying high dividends because they've always paid good dividends, but the share prices have been hammered recently for obvious reasons. The future prospects of those companies haven't been looking so great. So that is known as a dividend trap, and a lot of new investors fall for this. So just be aware of it, not to do that. The most important thing, if you're buying stocks of any sort, is that you're buying a great company. After that, you can worry about dividends and things like that. But number one is this a great company? One of the other main reasons that people like to buy dividend stock is the income. And to be fair, if you're an older investor, maybe you're in your retirement, then there is some sense in buying companies that pay dividends because in most cases, you're going to use that dividend as your income to meet your day-to-day living expenses. And this is very typical for retirees or those people who are leaving the accumulation phase of their portfolio buildup and in down the spending phase, let's say. So that can be a very big reasons why people would buy dividend paying stocks. But when you buy a dividend stock, be aware that you're probably going to get lower growth potential than if you bought a non-dividend paying stock. In fact, most of the big tech companies in the US, they started out, they didn't pay dividends for a long time because they wanted to take those profits that they made and reinvest it in new projects, new initiatives, and have the business grow further and further. Some companies still don't pay them, likes of Amazon, for example, and Berkshire Hathaway, the conglomerate run by Warren Buffett, has never paid a dividend. Why? Because Warren Buffett believed that what he could do with the profits from his company is reinvest it in new companies, new businesses, and get a higher return on that investment than he would do by paying somebody out a dividend. So in his view, his investors would have been better off by by having him reinvest that money at a higher rate of return rather than pay it to them as a dividend. And there's a lot of sense in that. So therefore, what he would recommend that somebody would do is we reinvest into new businesses, and they will create more value and increase the share price overall. So if you need money, you're better off selling a little bit of the shares that you have. And of course, those share prices should go up as the retained profits get reinvested at a higher rate of return than if they paid you the dividend. That's the methodology and the idea behind him never paying a dividend, and the likes of Amazon, for example. So I thought maybe a good way to illustrate this is to take two exchange-traded funds put out by Vanguard. One tracks the FTSE All-World Index, and the other tracks the FTSE All-World High Yield Index itself. And those are two different types of funds and companies within those funds, obviously. So the FTSE All-World is going to invest in thousands of companies around the globe, sorted by the top, and that being like the most valuable companies in the world, lots of growth, lots of tech companies throughout those, all the way down. If you look at the high dividend yield version of that, it bypasses a lot of the high growth companies and prioritizes investing in some of the bigger companies that pay good dividends. And they usually have a minimum requirement to go into the fund, being that they have a dividend yield of 2% or more. So the makeup of the high dividend yield fund is very different than the FTSE All-World fund itself. But what are the returns like? And this is what I think people should really know before they make that decision. Unless, of course, you're buying for a dividend fund because you need to use it as income. Okay, so I've got a side-by-side comparison here, and this is really the performance, the past performance of both funds side by side here. And the top one that you can see has got an ongoing charges figure of 0.29% is actually the high dividend yield fund at Vanguard. And I've taken the accumulation funds of both, so not the dividend paying, okay? So both funds would reinvest any dividends received, so it gives it a better like-for-like comparison. So if you look at these two side-by-side funds here, the high dividend yield and the FTSE All-World, what I want to look at here is the since inception figures. Now, they both came out in 2019, one in July, one in September, so there is about a month difference between that. But if you look at the return since inception, 66% for the high dividend yield versus 93% for the FTSE All-World. Remember, that's the one with more of a component of growth stocks, tech stocks, and things like that. So less focused on dividends. Another one to look at here is the column for the 10-year. If you look at the dividend yield, for the benchmark that is, because these funds have not been up and running for 10 years yet, hence why there's no data for that. But if you look at the benchmark, the 10-year on the high dividend yield is 101.74%. Now, if you look at the FTSE All-World, the 10-year benchmark, 160%. So you've had around a 60% outperformance by investing in the FTSE All-World, not prioritizing high dividend companies. So that shows us actually, even when you reinvest the dividends that you would get from a high yield fund versus a normal FTSE All-World, you get a better performance for the companies that are taking those dividends and reinvesting them into new projects and new businesses to earn more money. And of course, you could always invest in that fund and then sell it if you need the money at some point, rather than taking it as dividends. I think it's worth mentioning as well, if you're a young investor, I really don't think you should be thinking about dividends at all. You want long-term returns. You've got a lot of runway ahead of you, probably 30, maybe even 40 years. So dividends really should be nowhere on your radar when it comes to your investment portfolio, in my opinion. Another thing I looked at when I was comparing these two dividend funds, when it came to the volatility of them, there was very little in between them. So what that means is when the market actually goes through some sort of a crisis or shock, like we saw with COVID or say the Trump tariffs in April, they both sold off quite a lot. So there wasn't like you had some additional peace of mind by holding the dividend fund over the non-dividend fund as well. So that's another reason why maybe this is not something you should be considering in your portfolio, particularly if you're accumulating your funds now over the long term versus being in a retirement stage. So would I invest in a high yield dividend fund? Well, the answer is I never have done. I've looked at them many times, and every time I compared The performance history, I always came back to the same thing and thought I'm better off prioritizing great companies who get great returns on their capital, and they reinvest that rather than pay a dividend out to me, which I'm only going to use to reinvest anyways. If you're invested in an index like the S&P or the FTSE 100, you're going to get dividends regardless, and you should be reinvesting those. By the way, if you're a UK investor, the FTSE 100, the FTSE 250, they're very high in paying dividends when you compare them, say, to the US. But the reason for that is because the companies that make up those indices are not your high-tech growth companies that need that money to reinvest, like I mentioned. And therefore, they're made up of more companies like banks or mining companies, for example, who've traditionally paid more dividends, but traditionally don't grow as much either. So if you're looking for dividends because you want the income, then the FTSE 100 or the 250 might be a place you could look at. Indeed, I've seen a lot of clients over my 20 years in the industry holding FTSE 100 ETFs or companies purely because of the dividends. And while it might feel great with that money coming in now, over a 5 or 10 year period, you'd probably look at and compare that to an index like the S&P, and you'll see a pretty big difference in the returns that you've missed out on. But that's just how it is when it comes to dividend investing. Well, that's my video on dividend investing, dividend ETFs versus non-dividend ETFs. We use two really good ETFs from Vanguard, the Vanguard FTSE All-World versus the FTSE All-World High Yield. Have a look at those. They're all on the Vanguard website. You can check them out. I'll put a link in the description so you can find them just by clicking on that. If you like the video, click on that like button. I would really appreciate that. It does mean a lot when you do that. So thank you for doing it. Subscribe as well. I can't thank you enough if you're willing to just click that subscribe button. It is really important to me because a lot of my viewers are not subscribed. If you want to know what's in my portfolio, I've done a video on this. You can see it, no problem. Just click on the link right up here, my one fund portfolio. So click on that, I'll see you over there. And as always, I wish you nothing but the best in your savings and investment journey.